Hi guys, welcome back to my channel. For today's video, we're gonna be talking about real estate jargons for beginners. Let's begin. So let's start with the basics. Let's define what real estate is. Real estate is actually the land, the building, could be a house, could be real properties, physical. It's something that you can touch. It's something that's tangible. Okay, it could also refer to the air rights above the property and even below the property, the underground right. So let's define what equity is. Equity is actually differently defined here in the Philippines versus our counterpart in the US. When you talk about equity in the US, it's actually the market value of the property less the mortgage or the loan that you own from the lender. Okay, but in the Philippines, equity is actually what you pay upfront, okay, either to the developer or as your down payment, and then the balance is the amount that you take out to the bank for your mortgage. So let's say, for example, you paid for a 20% down payment through the developer, and after a few period of years, you pay the balance through the bank. So that 20% is actually your equity as defined here in the Philippines. Next up is what we call the reservation fee, or in some cases called as the deposit. So the reservation fee is actually what you pay to reserve the unit from the developer. So it's usually a very small amount which can be part of your equity, okay? And also in some cases it also forms a part of your down payment. But the reservation fee typically is a small amount compared to the total price that allows you to reserve the unit under your name, and most often than not, this reservation fee is non-refundable. Now, what is the down payment? Usually, it's what you pay after you make the reservation fee for a particular condominium or residential or commercial lot. So, for example, you made a reservation deposit or reservation fee today. Typically, after 30 days, you would have to make your down payment. So it varies from one developer to another depending on the payment terms that you chose. Some developers will allow you to have a split down payment wherein you can split, let's say, 10% over 6 months or 10% over 12 months. In some cases, we have what we call the no down payment scheme, wherein let's say 10% you can spread over 3 years, 4 years, some cases even 5 years. But typically when you talk about the 10% down payment or the down payment, it's usually after 30 days. Next up is what we call the lump sum or the final balance. Now, what is the lump sum? Remember earlier, you have to pay the down payment, you have to pay the reservation fee, you also have monthly payments. But at the end, there's usually a big amount that you need to pay to the developer. That's what we call the lump sum or the final balance. Now, the lump sum or final balance could either be paid in cash or partially cash and then the balance bank financing, or the entire lump sum or final balance could be financed through the bank through what we call the mortgage. So next up, we're going to be talking about mortgage. Now, what is a mortgage? Mortgage is just another term for what you call a loan that you get from the bank, but this one is specific to real estate. Mortgage is actually the loan that you get from the bank to finance your property. Remember earlier we talked about equity, right? So the difference, if you want to get a loan, is what you call the mortgage. So typically developers would have an arrangement with the bank that will allow you to get a mortgage. Okay, if not, if you're buying something on the secondary market, typically ready for occupancy units, then you would have to check what type of mortgage arrangement you will be able to get before you proceed with the purchase of the property, especially when you're not buying the whole amount in cash. Next up, we have what we call the other charges, or in some cases called as the closing cost. What are the other charges? So usually it relates to your documentary stamp tax, the transfer tax, the legal fees that you need to pay in order to transfer the property from the name of the developer to your name. Okay, so that's what we call the other charges or the closing cost. In some cases, developers would add administrative costs that you need to pay, and even some of the bill deposit for your, let's say, the electric meter fee, and even some cases they include the amount of the fire extinguisher for the condo unit. So it varies from one developer to another. To be sure, you may ask the developer what are the inclusions and the other charges. Next up, we have what we call the capital gains tax, or CGT. Capital gains tax is actually 6% here in the Philippines, but it's quite funny because it's termed as capital gains tax. So it should be a tax on the gain that you get from the property. Let's say you bought the property for 1 million and then you sold it for 2 million. Typically, you would earn about a million, right? 1 million pesos. So the tax should be on 1 million pesos alone and not on the 2 million selling price. But in the Philippines, it's quite different. The capital gains tax is actually computed on your selling price. So if you sold it for 2 million, even if you only gained 1 million, your 6% tax will be based on 2 million and not 1 million. So it's not actually, in principle, it's not actually a capital gains tax, but it's actually a sales tax. So don't be confused, especially for our foreign investors out there, foreign clients watching this video. It's very different. When you say capital gains tax, it's actually the sales tax on the selling price. Don't be confused. Next up is what we call the CTS, or the contract to sell. The contract to sell is actually the contract that you get from the developer when you're buying a condominium or a lot through installment purchase. So if you're not going to be paying in cash, what you'll get as proof of your purchase with all the terms and conditions for the property that you purchase is the contract to sell. Okay, so it's important then when you make your reservation, when you make your down payment, and you complied with all of the requirements, that you secure your CTS, or what we call the contract to sell. Now we're going to be talking about the deed of absolute sale, or what we call the DOAS or DAS in some cases. So the deed of absolute sale is what you get when you have already fully paid the property. So the developer is actually required to give you the deed of absolute sale once you've fully paid the property. So it's your right as a buyer to demand the deed of absolute sale from the owner or the seller once you have fully paid the property. Because if you don't have the title yet, that is your proof that you were able to fully pay the property and the transaction has been completed. Okay, now we're going to be talking about the two different titles. Number one, you have the CCT, or Condominium Certificate of Title, and the TCT, or the Transfer Certificate of Title. From the term itself, Condominium Certificate of Title is for condos. Okay, so you own a piece of the land and the specific unit that you purchase together with the other buyers or the other owners of the said condominium. So no particular investor owns the whole land. You own it as a group, okay? As a group of condominium buyers. So you'll be forming what we call a condominium corporation, which will hold the title for the whole building. Okay, now what is a TCT? As mentioned, it's a transfer certificate of title. It usually is applicable for lots. Okay, so if you have land, normally you would have ownership over that property by yourself alone. You're not going to be sharing it with other people because you're the only buyer. So if you buy also a townhouse or a single detached home or a duplex, typically it would have a TCT. So you own the property on top of it, the structure, the house, the building, and beneath it, the land, it's all yours. So that's the TCT, okay? But there are some cases wherein developers also sell townhouses or duplex, triplex property, but it's as a CCT. So please check before you buy if it's a TCT or a CCT, because there's a big difference. Next is what we call the tax declaration. Now the tax declaration is what you need to be able to pay the real estate or real property taxes to the government. So you would need to present that tax declaration in order to get a computation of how much RPT you need to pay for any particular year. We're going to be talking about how to compute for your real estate property tax in a future video, so watch out for that. Now, what is a landlord? Landlord is actually the owner of the unit or the owner of the property. Okay, so you are the one who's going to lease it out, okay, to a particular tenant. So that's what you call the landlord or the lessor. Okay, so in some cases you could be called the owner, the landlord, or the lessor. So that's all the same. Okay, but technically, if you own a property that's mortgaged or being financed by the bank, you're typically not the owner yet of the property. The owner of the property is the bank because you haven't fully paid the loan yet. So technically, you're not the owner. But generally, when we talk about the landlord, we refer to the owner of the unit, the one who purchased it, and not the bank. Now we're going to talk about the tenant. The tenant is actually the same as the lessee or the renter. It's the person or the company, the entity who pays you monthly payments, or depending on your arrangement, could be quarterly or on an annual basis. The one who pays you rent or lease every month to be able to use the rights of your property, may it be for industrial, commercial, agricultural, commercial reasons. If they pay rent on a monthly basis to you, then that's what you call the renter, tenant, or lessee. Now, what is passive income? So passive income, from the word itself, is income that you get on a regular basis without you having to put a direct effort to get that income. So just to elaborate, in real estate, once you buy the property, once you rent it out, you don't have to worry like every day or every month about how to get income from the property, because your tenant will be paying you on a monthly basis. So even when you're sleeping at night, not doing anything, the income still comes in on a monthly basis. Okay, so that's passive income for you, as opposed to active income, wherein, let's say you have a full-time job wherein you are paid for the number of hours, days, weeks that you work, okay, on a salary or wage basis. That's active income. Or if you have a business, you have to manage your business daily, take care of your employees, find clients, manage the business, make sure the costs and expenses are all in line. Then that's what you call active income. But passive income is income that you get without having to put in a lot of effort. You're just waiting for it to come in on a month-to-month basis. So that's passive or residual income. Next up, we have what we call capital appreciation. So capital appreciation, to make it easy for you to understand, it's actually just the price appreciation of your property. So again, going back to our explanation earlier, let's say you bought a property for 1 million, and then after a year it increased to, let's say, 1.1 million. So your capital appreciation is actually 100,000 pesos. So it's the amount of increase in value of your property over a period of time. That's what you call capital appreciation. So now we move on to amortizations. Amortizations are actually the payments that you pay to the developer or to the bank. This includes your basic payment, on the principal, as well as any interest that may be charged to you by the developer or the bank. So when you add those two, that's actually what you call amortizations. Okay, we're down to our last two. Let's talk about freehold versus leasehold. So freehold is actually the same as perpetual ownership. When you say freehold, you have ownership over the property for life. Okay, so you don't have to worry that after 50 years you have to give it back to the developer, okay, or the landowner, or in some cases 99 years. In some countries they have what we call 999 years leasehold ownership. Okay, so that's the difference between freehold or perpetual. Now, most developers in the Philippines would offer what we call freehold or perpetual ownership properties, especially the major ones. But if you want to be extra safe or extra careful, make sure to check this with your agent, check with the developer if what they're offering is freehold or leasehold properties. In the Philippines, since we still have a lot of land, a lot of property where we can expand our developments, most projects are freehold. But in countries like Hong Kong, Singapore, where land is very short in supply, there's scarcity already, then most of their properties are being sold on a leasehold basis. But in the Philippines, mostly it's all freehold. Okay, so that sums up our real estate jargons or terms for beginners. I hope you learned a lot from it. And don't worry, we're going to be talking about the more advanced concepts in future videos, so please watch out for that. Before I let you go, I'm going to promote my website, which will be opening pretty soon. The website is www.propertyking.ph. Also, we'll be opening our Instagram and Facebook accounts pretty soon. So if you want to contact me, please reach out to those social media accounts. So please give it a thumbs up, press the subscribe button below, and don't forget to smash that bell icon to get notified of future videos. Again, this is RK. Thank you so much, and let's all grow wealthy together.